you normalize rent increases 3% year over year. That's kind of a standard rule of thumb. I like to round everything. So I like to round everything typically to $5 or $10 increases, which on a, $45, a $60, $100 a unit is definitely more than 3%.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I am your host today. And we are going to focus on passive investing in primarily self-storage today. I've got a friend with us today, Ben Kall. Ben is actually the partner on Legacy Investment Group. He started in the real estate space back in 2016, I believe, and he has accumulated over 65 million assets under management since that point. So welcome to the show, Ben. Thanks so much for being here.
Yeah, absolutely. Thanks for having me, Randy.
Awesome. Well, Ben, why don't we go ahead and jump in? Can you tell us a little bit more about yourself? I know you've got a background in, I think, Kansas State University football, and that led you into real estate, of course. So maybe kind of walk us through that path.
Yeah, it's to keep the story short, I sports was everything to me growing up. I played college football at Kansas State. And before I graduated, my coach asked if I would be interested in a new position that was opening. So I got hired onto the Kansas State football team coaching staff, and I did that for about 4 years. Along the way, I got married, and essentially, over time, getting married, your priority changes as a man, right? And so we realized that college football and that profession was not for the life that we had envisioned. And so basically we needed to do something different. And I didn't know quite what I wanted to do yet. So I moved back to my hometown of Rochester, Minnesota, became a licensed real estate agent, essentially as a holdover job until I found something in sports again. And being a competitive athlete, I just kind of jumped in head first and hit the ground running. And surprisingly, I really enjoyed it. So I started as an agent selling houses, but basically having nothing. And I said yes to every opportunity. So next thing I knew, I was selling houses. I was selling hobby farms. I was doing commercial leasing, commercial sales. And along the way, as I was doing all of that and building the brokerage, just the sales side of my business, I started a third-party property management company where I was managing everything from houses to multifamily to Section 8 to commercial strip centers with tenants such as Chipotle and Verizon. So I was learning from a fire hose over my first couple of years of being a real estate agent, broker, and property manager. And finally, it was one night, I remember it very vividly, that I was lifting a snowblower out of the back of my truck at midnight after we just got a foot or so of snow and it was super windy. And I was snowblowing someone's driveway. And I had a light bulb that went off that said, why the hell am I doing this? Why the hell am I making other people money? I need to start doing this for myself. And then I started to kind of put some feelers out there to start exploring by really reading and starting to listen to some podcasts. And just all of a sudden, the stars aligned. And a guy that I had actually managed some of his multifamily portfolio for had called me and said, Ben, I have an opportunity. It's bigger than I could do on my own. I definitely don't want to operate it. And you've done a fantastic job of operating everything for me. Would you want to partner? And my very first investment was a $1.5 million self-storage facility. Nothing that I knew anything about. But I was excited because I looked up to the guy that asked to partner. And I was the operator. So I was kind of young and dumb and said yes. And we figured it out. And here we are today.
Wow. That is, I love the fact that you said very early on, you said yes to every opportunity that came. And ultimately that probably played well for you during your sports life, into getting married and then also into this space as well. So back up a little bit if you can. You mentioned that you were doing a snowplow shovel thing. I'm from Northern Michigan, so I understand everything there is to know about snow. But how far into your real estate career were you at that point when that light bulb came on?
So I started as an agent and property manager in 2016.
Okay.
And we acquired my first investment, which was the storage facility I referenced in September of 2018.
Wow. So just a couple of years passed at that point, and then you were kind of a 50-50 partner with a guy buying $1.5 million self-storage facility. Interesting. Now, was this self-storage facility, was it in your neighborhood? Was it in your city or zip code, or
Yeah,
was
so
this something you were driving to?
it was about 20 minutes from my house. It
Okay.
was in a market where I had sold quite a bit of property, in the first couple of years that I was selling houses. It was in the same market as some apartments that I had property managed. So
Okay.
somewhere that I was very familiar with. And the lead that came in was through a lender that both myself and my current business partner had worked with quite regularly. Because that bank had had the loan for years, and so
Uh,
they believed in the property, and they thought we would be a good potential buyer. So it
wow.
was kind of the everything aligned, from the opportunity to become a partner in something like this. The lender knew it and liked it. It was in a market that we liked. So there was a lot of things that just aligned, like I had said.
Yeah.
And being the first one, you just kind of, for me at least, my mentality in that one was, I really want to do this.
Yeah.
And I trust the lender. I trust my business partner. We'll figure it out.
I love it. I love it. So you're kind of a guy who says yes and build the parachute on the way down, essentially, right?
Yeah, that
Interesting.
was definitely the first couple, because you don't know as much, right?
Sure.
And so you don't know as much, so you obviously, look at some of the risk and try to ensure that the world's not going to topple over. But
Yeah.
then as you continue to grow, you build confidence, you build knowledge, you look at things a little bit differently. The way that I underwrite today is immensely different than it was 6, 7 years ago when I was getting started as an investor.
I'm sure.
Everything's gotten a bit more complex. But now one of the things that you start to listen to, especially in today's economy, is personally guaranteeing. The amount of loans that I have is not something to be taken lightly.
Yeah.
And so we look at everything very, very closely. We underwrite an immense amount of potential risks or things that could go wrong to ensure that we're still buying and operating properties correctly and efficiently and safely.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So looking back at that first deal, had you come across that deal today, is that still a deal you would buy today?
In today's economy, 100%. We bought it at an in place, just above an 8 cap, in
Okay.
place in 2018. So today you couldn't buy that facility. It would trade at about a 6 cap.
Okay.
Yeah. So the value has gone up immensely, and we would absolutely buy it again today.
Okay. And so do you still own it today, or is it
We do.
something that you do? Okay. So you're a buy and hold guy, it sounds like. You're not do you do the value add strategy at all, or do you
Yeah,
um
so that storage was my very first investment, and the bulk of my portfolio is self storage. So
okay.
you'd mentioned I own about 65 million of real estate. Half of that is through self storage, and then the other half is split pretty evenly between multifamily and triple net. So each asset class we have a little bit of a different strategy to, but we like to add value to each of the properties that we buy.
Okay.
We're not the guys that go in and are, doing $20,000 remodels to an entire 100-unit apartment building.
Okay.
We like the simple stuff, just operational efficiencies, rent increases, modest cosmetic updates to apartments,
Okay.
and just doing a better job of being an owner and operator is kind of what our niche is.
Okay, interesting. So now value add, we primarily focus on multifamily on this podcast up to this point, but can you talk about what the value add strategy looks like in self storage and even triple net for that matter? It'd
Yeah,
be
so
interesting to
the
learn that.
self storage traditionally is owned by mom and pop. It's just been over the last couple of years, specifically since the beginning of COVID, where some of the institutions and publicly traded companies started looking at self-storage. So it was a very kind of quiet, under the radar asset class, which means the majority of storage across the entire country is owned by mom and pop operators. And a lot of them have been owned by those mom and pop operators for many, many years. So, for me, when I'm hunting for a deal, I'm looking for something that doesn't have a fancy, easy to use website. It doesn't have a Google business page. And the only way you can really find it is driving by or calling the number on the sign outside the facility. So that's a lot of what I'm looking for. And so if I can find that, I know I can basically modernize all of it. And the mentality that I took on my very first one, which I still kind of use today, is I try to bring the property online and market it very similar to how a Marriott or Hilton hotel would do it. So if you have kind of the online concierge is what I like to call it, of being able to rent a unit online in less than 5 minutes, right? It's very easy to find online when you search it in Google. And you can look at the rental sizes, you can look at the rental rates, and you can rent it in less than 5 minutes. You get an automated text message and email that says, "Thank you so much for renting with us. Here's a copy of your receipt, and here is a 4-digit code for the lock that we provide for you. Please let us know if you have any questions. By the way, please write us a review."
Yeah.
And so someone can rent a unit from us in less than 5 minutes. And the nice piece about that is, if you can optimize these as efficiently as I just mentioned, people in the storage industry, one of the fantastic things that I like about it is there's a lot of different levers you can pull to create value. And one of the biggest one is simple rent increases of $3, $5, $10. Because if you have, the size of a 1-car garage full of all of your belongings, if rent goes up by $5, you're not going to load it up into a truck, make 10 trips down the road to save $5,
Yeah.
right?
Exactly. Yep.
And so by having a conveniently easy to find and use facility, you can charge more because of convenience.
Yep. And $3, $5, and $10 per month as a percentage, I suspect, is much more than the small rent increases we see in multifamily.
Yeah. Typically, if you're going to underwrite something on a pro forma basis, you normalize rent increases 3% year over year. That's kind of a standard rule of thumb. For storage, there are a lot of people who like to raise rents on a percentage basis. I like to round everything. So I
Okay.
like to round everything typically to $5 or $10 increases,
Okay.
which on a 45, a 60, $100 a unit is definitely more than 3%.
Yeah, interesting. So then you have, and I suspect that you can adjust rates based on occupancy much quicker than you can in a multifamily as well. So what is that? Is there like demand pricing, or is there some
Yeah, so
models? I've
that's
heard some podcasts talking about that. It
Yeah,
seems
so
like.
that's one of the things and why I love storage. Initially, you have my first facility was 255 units. Every single tenant was on a month-to-month lease, which initially scared me, right?
Yeah. Yep.
But the nice thing about it is everyone is on a month-to-month lease, so you can pull different levers with rent increases every single month. I don't necessarily like to do that because I'm a local operator, and a lot of people who rent from me know me.
Sure.
But
Sure.
yes, you can raise rent quickly. And so dynamic pricing is something that's really popular in storage.
Okay.
And so what that means is if your portfolio is 100% full, you raise rent across the board. But if there's certain units that are in higher demand than others, you only
Right.
need to raise rent at the ones that are full. So for example, if I have 10 by 20 units and they're 100% full, but I have 10 5 by 10s that are 50% full, I don't raise rent on the ones that aren't full because there isn't
Right.
demand. So I
Yeah.
only raise rent on the units that are full. And so that's why you can do more rent increases per year than just a one time per year, very similar to apartments.
Yeah, very specific and specialized based on the occupancy rates across those. Very interesting. Okay, now so you talk about this idea of being able to rent in 5 minutes, and once you put that functionality in place, then that would increase your profitability, I suspect, pretty quickly. Do you find that renters, are they driving by or coming to the facility to see it before they go through this 5 minute process, or is it just simply they're doing a Google search, finding something in a geography, and then pulling the trigger?
Yeah. So when I got started, these systems weren't in place right away. We created a website, we created the ability to rent online and pay online right out of the gates. But it's taken us a couple years to figure out how to optimize everything a bit further from a convenience for us as owners and managers, because we manage everything in house, but also from the client side. So before, there was a key for every single unit. So I would have to actually drive out there to hand somebody a key, lift open the door, show it to them, and drive back. So it'd
Okay.
take an hour of my day to give one person a key for a $45 unit. So
255 units, right?
yeah, and
Yeah.
and
Oh
so
my
as you
goodness.
continue to scale, you got to find another way. And so
Sure.
there's different locking systems out there now that is more remote. But to answer your question, I would say less than 1% of people actually want to look in the unit.
Hmm.
But what we've done is we've taken videos of different unit sizes, showed them how the locks work, show them what's inside the unit, a little drive around of the property. We save them as a YouTube video and put them on our website for people to see. So that
Love
way
it.
it cuts down on the time needed because every unit inside's the same.
Love it.
It's just a different size.
Okay. And so are they all branded the same across your whole portfolio? Is it like um, legacy storage and there's 40 different locations, so you go to one website for all the different locations, or
Yeah. So right now I call it two different storage portfolios. So one is all essentially in a radius of about 20 minutes of my house. That
okay.
portfolio is called Legacy Storage, and each of those are branded based Legacy Storage, and then the town after it, and it rolls up into Legacy.
Got it.
The other portfolio is another. It's up in northern Minnesota, and we call that one Minnesota Storage Group.
Okay.
And so that one, our thinking behind the branding for that is it's just a little bit bigger and defined as Minnesota Storage. So
Sure.
part of my goals is to be one of the largest private storage owners in the entire state of Minnesota. And so we will hopefully combine everything into one large portfolio over the years. And eventually, when we want to exit, it would be one large portfolio across the state. And our hope is that we would sell it to an institutional buyer.
Interesting. Interesting. Okay. So 2016 to today. So you're talking 7 years, going on 8 years in this space. And it's about mid 30 million for self storage. It sounds like, if that's 50/50.
Yep.
Okay. Yeah, interesting. So it, let's, if we can, talk a little bit. It sounds to me like operationally you're doing in-house property management so you can control that piece. Do you do any development in addition to those? Are you buying properties that have extra land to add more units, or are you
Yep.
just
Yeah, so
you
it's
are?
always a bonus if you can buy storage that has additional land to expand for storage facilities.
Okay.
And one of the other interesting things on a recent acquisition is that there was a lot of land, more than we could probably develop over the next 10 years.
Sure.
And so we're looking for other uses such as cell towers, solar farms, battery warehouses, because
Hmm.
when you do a solar farm, all of the power that is generated from the solar panels needs to go into battery storage so it can essentially be harvested for the
Okay.
utility companies to use it for the city.
Got it.
And so there are a lot of solar fields that have been built over the years, but there aren't battery storage facilities.
Interesting.
So we're
Okay.
looking into some other niche value add opportunities we can do with some of the excess land that we have.
Interesting. I worked with a group in Las Vegas that built some of their solar fields, and I mean, there's like hundreds and hundreds of probably thousands of acres of solar. And the client of mine was in the HVAC space and had to provide the essentially the cooling for those facilities. That I think they were conversion something, but yeah, very interesting. Okay, so you guys, you're not just a self-storage guy who does that cookie cutter over and over and over again. You're doing all kinds of different things to kind of maximize really the opportunity, and probably going back to that initial thought of say yes to every opportunity. I suspect though, as the business has grown, you're having to potentially limit what you say yes to. Is that uh, part of the transition as well, or
Yeah, 100%. And as we've grown, specifically because of the size where we're at, we do invest in three different asset classes.
Mhm.
But I really like that because it creates some diversification. You look back through COVID and you look at hotel operators and office users, they've just
Yeah.
gotten pounded. And I
Yeah.
couldn't imagine having all of my eggs into the office space because my life would be changed forever in everything
Yeah.
that I worked for. So I like the idea of diversification, and a lot of the investors that we work with really appreciate that as well.
Yeah.
And the thing that we have done, however, is we've really, really defined our buy box and really narrowed down the criteria of what we're looking for, not only to buy, but the locations, the states, and the specific markets
Okay.
that we're looking to buy because of our familiar with each of those.
Interesting. Okay. Well, let's talk a little bit, if we can, because this podcast is geared, as you know, to the newer passive investor. We've primarily focused on multifamily in the past, but I personally have invested in self storage with a rather large operator that I'm sure you know. But can you talk a little bit about kind of that investor profile or even the investment profile? Let's go there first. Like, what kind of returns can investors expect? Is there a reason to go with self storage over multifamily? How do you guys do in times of recession? Those types of things.
Yeah. So from what we look to acquire, each of our asset classes are a little bit different. But right now we like to look in the $5 to about $20 million price point for each of the asset classes. We like that price point because there is an immense amount of buyers in the 1 to 5 million, so it's very competitive. So we don't see the returns that we typically like.
Interesting.
Once you get north of about 15 to 20 million, now that's where there's a lot of institutional buyers that have access to different funding sources than probably myself or you could get through insurance companies and some other options. So we found that in the 5 to 15 ish price point is where we really like to hunt. We like to look in growing markets that have been growing at about a 3% rate year over year for the last 5 to 10 years. We don't just want to see a little blip because of people relocating because of COVID.
COVID, sure.
So we look in larger population areas or within 30 to 45 minutes of those. So a little bit tertiary of a market, but that have access to somewhere that's a higher population area that has a lot of larger jobs. So
People
we
are
like markets.
commuting into the larger markets
Yep.
from your markets. Okay.
Yep. So we really
Yep.
like to see, Fortune 500 companies or close to those. We like to be around hospitals, universities, and major employment centers.
Okay.
Now, looking between storage, multifamily, and triple net, there's a very different reason we like each of them. I'm a firm believer in multifamily. There's been a massive drought in construction and development for the last 10 years, and it's even worse. So I think the need from housing is off the charts and will be forever. So
Yeah.
that's why we like investing in multifamily because everyone needs a roof over their head.
And do you
Uh,
guys do value add like class B, A minus,
Yeah,
C's?
we
What do you guys do
really we
there?
really like to focus in the B class.
Okay.
That I think the A class tends to get hit first in the
Yep.
time of recession, and we're just not set up operationally for kind of the workforce or Section 8 housing. We just don't
Okay.
have the manpower because of the paperwork that's needed. So
Sure.
we like B class multifamily.
And and the headaches that come along with C class tenants, C class operations, no doubt. So
Yep.
okay. Yeah, very good. And in same type of markets as well. Do you look for the
Yeah.
same markets for all of your assets? Okay.
Yep.
And then the triple net, we've talked about that a little bit, but I'm curious, is there kind of like a high level overview that you like to share about what is triple net and why would you invest in that space, those types of
Yeah,
things?
so triple net can be an array of things, but what we look at is kind of like your local retail shopping center. That is in the parking lot or across the street from Target, Home Depot, Walmart. Those guys do an immense amount of homework, so we like to follow them.
Yeah, yeah.
We like to be in highly populated, highly visible, and highly trafficked areas.
Okay.
And without getting too complex, triple net essentially means that a tenant moves into a building and pays you rent. But like in multifamily, where you have other expenses such as property taxes, lawn care, snow removal, etc., triple net means that all of your expenses get passed on to the tenants and they reimburse you through what's called is CAM. And
Got it.
so it kind of normalizes your returns to an extent because you have a really good idea of what your income and expenses are going to be. And if
Got
for
it.
some reason your operating or expenses are higher one year, you do what's called a CAM reconciliation, and your tenants reimburse you for what was outside of the budget that you had planned for.
Got it. And as an operator, you get to leave your snowblower at home. You don't have to. You
100%.
don't have to deal with that. Yeah. Okay.
Yeah.
Very good. Well, yeah, very interesting. It's not often that I run into folks that are dialed in as much as you are in three different asset classes, because just getting your head around one asset class can be very, very challenging. So, can you talk a little bit about why you've chose to play in three different asset classes versus just focusing on one? Was it just simply that COVID office fear that is driving that, or is there something else as well?
No, I would say at the beginning, it was because I'd been a property manager managing these asset classes.
Okay,
Storage is kind of the unicorn because that was my first investment. But purely
sure.
from a third party property manager operations, I was managing houses, multifamily, Section 8.
Okay,
On the commercial triple net side, I was negotiating with Chipotle Corporate. We have Panera's, Verizon's, mom and pop, nail salons. So I was managing all of those properties, so
yeah,
I was confident that I knew what I was doing.
okay.
The only thing I wasn't confident in at first was identifying the good locations that would bring the type of tenants we wanted. So
Hmm.
that's where I focused a lot of my time initially. And I did it on my own and with one JV partnership.
Hmm.
We acquired a couple properties, triple net properties first to ensure we knew what we were doing to kind of work out the
Sure.
kinks
Yeah.
before we started opening up those opportunities to our investors.
Bet with your own dollars before you do with your investors. Very
Yep.
good. Very good. Okay. Well, let's now you mentioned JV, but are you syndicating everything today?
Yeah, and so that was not something that I had planned.
Okay.
Initially it was, done on your own, done with a partner. But,
Sure.
as soon as you start doing multi-million dollar deals and you're doing them yourself or just with a buddy, your
Yeah.
cash goes really, really quickly.
Yeah.
And it's just, one of those things that's interesting that the more deals you do, the more opportunities that come to you because of a track record with sellers, other brokers, market expertise. So I hated the idea of watching a good deal get passed on. And so one of the reason I got a coach and joined Go Abundance and Action Academy and a couple other masterminds is to kind of
Sure.
work through some of these limiting beliefs that I had. And the idea of starting a private equity or syndication company scared the hell out of me
Yeah.
because now I'm managing other people's money. I'm the one who's going to fund their kids' college. I'm going to fund their retirement.
Yeah.
And all these other things are kind of on my shoulders, and so it scared me.
Yep.
And so I worked through that for quite a while. And eventually, what I just realized is that over the years, a lot of people had been asking to invest with me. So we tried a syndication and kept it small just to our local friends and family.
Hmm.
And we were oversubscribed in a couple weeks. And then we
Wow.
do the next one, and same thing happened. And
Wow.
so then we kind of built a track record over the last couple of years of just organic word of mouth, and a lot of our investors continuing to reinvest in each of our deals when we bring one out.
I love it. I love it. Yeah, because if you take investor dollars and you return it back to them with a solid return, odds are they're going to come back to you time and time again, right?
Yeah,
So,
and when we started the company, I started looking at some of the bigger public names that are out there. We looked at some of the publicly traded companies and tried to blend a model that worked for us. And being new to me, if I didn't understand it, I wouldn't be confident in it, and I couldn't explain it to my investors. So the way that we set up our company is the number one thing that we looked for was alignment between the sponsor, meaning myself or a general partner, and alignment between the general partners and the sponsor, and also the limited partner or the passive quiet investors. And so I
interesting.
thought alignment was the number one thing that we needed to focus on as we were building this. And so the way that we did it is we have a 75-25 split, meaning 75% goes to the investors, 25% comes to the sponsors after 100% of the investors' money is returned to them. So the goal is I don't get any of my quote unquote sweat equity
Yep.
ownership incentive until
Yep.
you have been returned your entire investment. And
Okay.
so there's alignment there for me to work quickly, efficiently, and do a great job because obviously I want a return on my time and operations. So that was the biggest one, which is a lot better than the market industry. But the other thing that we did as well that was really important is we don't charge any fees. The only fee that we take is a property management fee because we keep that in-house. And we think a lot of that is part of our kind of operational value add because that's what we believe we're pretty good at. And then the last piece, and this has been one of the biggest one to investors when we have conversations with them, is that us as the general partners are always typically the largest or in line with the largest investor
Okay.
as a limited partner in all of our deals. So we have
Interesting.
skin in the game as well.
So you guys aren't charging acquisition fees, disposition fees, AUM fees, development fees, anything like that at all. So
Nope.
literally, you could close on a self-storage facility, operate it for 2 to 3 years, and you personally would not make a dollar other than the property management company, which you need to charge fees because it costs money to run that business, right?
Yep. So
Interesting.
we take a market or below management fee, but
Okay.
because I'm also if you invest $100,000 and I invest $100,000, our quarterly distribution will be identical as limited partners.
Love it.
So yes, we are
Love it.
taking management fee, which allows our company to operate and run, but
Yep.
I'm also getting quarterly distributions along the way as a limited partner. And so we knew
Fantastic.
starting this, if this was just my only business, it would be slower, right? And it would be hard to, keep the lights on, feed the family.
Yeah.
But I had already had an established business and established investments that I'm getting paid distributions on where we can live our life.
Okay. So now you mentioned that first asset that you bought in 2016. You still own that asset, so you're not flipping these deals. Um, are you doing cash out refis, or how are you making your investors whole on that 100% before you start earning your 25%?
Yep. So the initially when you buy it, the investors are getting quarterly distributions after we believe the property is stabilized. And so, dependent on the property, the asset class, we typically stabilize a property in as short as maybe a quarter, 3 months.
Okay.
But
Wow.
typically, 6 to 9 months is what it takes for us to stabilize a property.
And what's
One
cash on cash generally, or what are the targets for cash on
So
cash?
we like to target a minimum of a 6% cash on cash in place at the time of close, and we like to
Okay.
build that up to 8 to 10% plus, over time. And we look for an IRR of north of 15% is what we target.
Okay. Interesting. And I apologize. So um, do you do cash out refis along the way, or
Yeah, we will. So initially, it all depends. So a couple of years ago, right, we're getting interest rates in the threes and fours. So we have no
yeah,
incentive to refinance
of
right
course.
now.
Yeah,
Yeah, so we have
absolutely.
no incentive to refinance until we need to. But yes,
Got it.
our investors are getting paid quarterly distributions, and then they typically will get a larger chunk at the time we would do a refinance, which
Got
typically
it.
happens in call it years 3, 4, 5.
Okay. And is the goal long term hold? This is a 20-year hold, or uh,
Not necessarily on all of them. When we model all of these out, there's no, bullseye on, the month or year we're going to sell it. But
okay.
investors do like to know, like, hey, are you going to refinance in, years 3 through 5? Yep.
Sure.
Are you going to plan to refinance again or sell it sometime between years 7 through 10? So typically, we like to tell our investors that we're going to look to sell the property sometime between years 7 and 10.
Got it. So you get a
You know, and,
refi
and
midway, and then
yeah,
something interesting. Okay.
and with that, some of our investors, it'll turn out it's a great property, and some investors will like to stay in.
Okay.
So, when you exit or look to sell, that would be the time you kind of liquidate.
Hmm.
And some investors will reinvest with us into other projects.
Yep.
And we might turn out this is a property that, us as sponsors, we might want to hold on to. And if
Okay.
there's investors that want to stay in with us and that particular asset, we'll allow them to do it because we believe in it.
Got it. Got it. And you personally, though, the goal is acquire as much cash flowing real estate as possible for you and your family and your generational wealth to carry on from years and years to go. Interesting. Yeah, very good. Well, this is yeah, it's an interesting model. I'm blown away that you do a 75/25 and no fees. Um, I don't know that I've ever heard that before, quite frankly. So that is
And
amazing.
and to be honest, when we built the company and came up with that structure, we knew it was investor friendly. But a lot of that was we didn't know if we were going to have one investor or 50 investors.
Yep.
And so we wanted to create that alignment, like I had mentioned. And we knew if we had alignment with our investors and it was investor friendly, we would be able to grow the company.
Yep.
And my company is named Legacy for a reason. We're not just a, overnight, buy something and flip it and away we go and we're out of the country.
Yep.
We want to hold on to things for a long time. We want our investors to reinvest with us in every single deal that we do. And we want to be around for years and years and years. And hopefully, my kids want to take over the company, right?
Yeah.
So
Fantastic.
if we build it this way, we'll be around for a long time. And economically and selfishly for myself, if we continue to do this for another 5, 10, 20, 30 years, passively and my cash flow will be very, very good. So this is a
Mhm.
model that we knew is very, very sustainable for a long period of time.
Good for you. Well, congratulations on the success. That's absolutely amazing. 65 million in a relatively short amount of time. You've done amazing things, and to be across three different asset classes. I'm curious, do you do single asset investments, or have you ever considered a fund where you have all three different assets into one?
We would like to do a fund in the future.
Yeah.
We've only been syndicating deals for a few years, and
Okay.
right now our investors really like to look at the individual deal, to
Yep.
place their money in individual deals based off the location, the asset class, the return profile, the time in the economy. But from a simplification for us as operators, a fund would be easier. It's a
Mhm.
lot less expensive legally to do a fund than five syndications a year.
Yep.
And I think it would be a lot of fun to come up with a unique fund opportunity, especially in today's environment.
Yep.
So I think it would be a lot of fun and something that we'll definitely look towards doing in the future.
I love the idea, the thought of having one investment across multiple assets, technically multiple markets and multiple asset classes. That sounds really appealing to the new or newer investor. My very first passive investment was in a fund. I didn't even really know what a fund was when I first started doing it, but the idea of diversification was really exciting to me at the time. So, yeah, well,
And I think the nice thing for us is right now, all of our deals are individual opportunities. So it's hard to say what us as sponsors what our overall return is across the entire portfolio, right? So in
sure,
a fund, it's a lot easier to say Fund One produced X return over a 7-year hold. So it's a
absolutely,
lot easier to kind of market and explain that to investors than here's all the different assets, here's all the different deals, here's all the different
sure.
exits. But right now, we're having a lot of fun doing it the way that we are.
Yeah, no, it sounds. I mean, you're building an amazing track record, obviously, and with the just spending a little bit about time that I have with you here today, it sounds like you probably have very strong relationships with your investors and open and transparent reporting. And I love the fact that you got in-house property management as well with your varying levels of expertise. So, yeah, really excited to meet you and to learn more about your business. That's it's been a lot of fun.
Yeah, no, absolutely. It's always fun talking about it. The reason I kind of pivoted from being a day-to-day real estate agent selling houses is because investing, creating opportunities, just from a deal flow perspective, and then playing with the multitude of levers you can have to create value
Yeah,
without your expenses going up, is something that just gets me fired up, and I'm really passionate about. So
yeah.
I would say that the spot that I'm in right now is where I'm having an enormous amount of fun, and I can't wait to continue to be doing this.
And what a thing to be able to build your own legacy and then help all of your investors do the exact same thing. It's just, that's amazing. I love it. Very good. Well, it looks like, gosh, we're already nearing our time here, but I do have a handful of questions I'd like to ask everybody on the podcast. So if you've got a few minutes still, I'd love to run through those quickly if we
Oh,
can.
absolutely.
Awesome. Well, you mentioned early on that you started listening to podcasts and reading books about the space to start your education journey. Are there any specific resources that you would direct a new or newer passive investor to start learning more about this space?
The podcast that I listened to right out of the gates was Bigger Pockets. It's the one of
Yeah,
the biggest investing podcasts in the world. That's kind of what got
yeah,
me fired up and got it started. I don't really listen to that one anymore. I listen to quite a few different podcasts now, but I where I spend a lot of my time is at masterminds and conferences, on the different asset classes because I can talk to people like yourself to really drill on in exactly what I need help with in my life, and also in my business.
yeah,
I would say for investors looking to get started, I would say to listen to podcasts. This is a great one, especially geared towards passive investors that might have a W-2 or a job that they're passionate about, and they're looking to just diversify their options. So podcasts like this one, or if you're looking at a specific asset type, go find a self-storage podcast, go find a multifamily, go find a triple net, go find a warehouse, go find a small business and listen to them over and over and over to, educate yourself to be able to ask operators like myself or other ones, really good quality questions so you feel comfortable placing your investment into that opportunity. Because I'm a big believer that people invest with people that they like and trust. And so originally for me, people were investing in me. They weren't investing in my very first deal in Wichita,
Right.
Kansas that we
Right.
brought to our
Yeah.
investors. They invested in me and my track record because they liked me, and they trusted me with their money.
Very good. I love it. And I was kind of the same way. I listened to a Real Estate Guys radio show in Bigger Pockets when I first started. And then from there, I did the squirrel thing where I jumped into all kinds of different things, but that's ultimately where you find what excites you and what gets you excited about investing. So, any current books that you've read in the recent past that you mentioned masterminds, so I suspect you're probably involved in mindset stuff as well. So, any specific books that you like this year?
The one that I'm actually currently reading is Who Not How.
Yeah.
A lot of how I built, is kind of the quote unquote bootstrap.
Yeah.
So as I mentioned at the very beginning, I was doing the lawn and snow at all my clients' properties and all of my own for years.
I love it.
And so I built everything, by being a doer. And so now at the point that we're at right now, we have a team of people, and I'm I don't like saying it, but I'm a boss now.
Yeah.
And we work with a team. We have various systems in place. And so the book Who Not How is the one that's very impactful right now that I'm actually working through as an exercise.
Okay.
But one of the Rich Dad Poor Dad was a huge one when I got started. And
Yep.
then the other book that I reread every year is Millionaire Next Door.
Yeah.
There's a quote in that book that says, "Don't let your lifestyle creep until your passive income can support it." And so that's something that we've lived by religiously to be able to do what we've done from an investment standpoint.
I love it. That was I read that book probably over 20 years ago. And I can still remember the guy wearing Levi's jeans and not the $1,000 suit, right? That's
Yep.
next door,
Yep.
driving the 15-year-old Taurus or whatever it was at the time, right?
Yeah.
Very good. Let's see here. So here's kind of a fun one. What is a recent bucket list item you've checked off your list or one you're hoping to in the near future?
I'm actually living it today. My wife and I have always wanted to spend a month in Colorado. So I'm
Okay.
based out of Minnesota. We love Colorado, the people, the atmosphere, being outside, being active. And so we just got to Breckenridge, Colorado a couple days ago,
No
and we are
kidding.
here for an entire month. We're right next to the gondola, so we're skiing every single day. The
Fantastic.
goal for me is not to work more than 2 to 4 hours a day and be able to recharge and kind of use some slow time in our
Yeah.
business to really vision and goal set for 2024.
Very good, because the snow it's maybe not flying yet in Minnesota, but it will be soon. I got a picture from my mom, first day of hunting camp, and there was no snow on the ground, which is bad news for the UP. So
Yep.
interesting. Very good. Well, congratulations. That's amazing. And how's the snow up there so far this year?
It is actively snowing. I'm looking out the window right now. It is actively snowing. There's a lot of man-made snow, so the whole resort isn't
Sure.
open yet, but they got about half of it open.
Fantastic. Fantastic. So, one final question. If you were placing 100 grand in capital today, and you couldn't put it in your own deal, where would you put that capital today?
That is a great question. Something, to be honest, I need to think about because I've never done it.
Okay.
All of my income has always been reinvested into myself
Okay.
or into my own projects. I'm in two different masterminds, one called GoBundance and another one called Action Academy. And so there's a few different operators that I look up to that we share a lot of tips and tricks. So I would probably reinvest with a couple buddies in one of my masterminds that I'm in.
Any particular asset class that you like more today? Um,
You
and you can
know,
choose your own in this
I
one.
think
Yeah.
it depends on the opportunity. So we didn't
Okay.
really dive why I like all of the asset classes that I'm in.
Yeah.
I think that in the triple net space, there's the ability to multiply your money a little bit faster than some of
Okay.
the others. For example, if you buy a retail shopping center that's 80% occupied and there's one vacancy, you put one tenant in there. This is a recent one that we did. We placed a 10-year lease with a corporate Pizza Hut into our one vacancy.
Okay.
The day we got the lease signed, the value of the property went up over $800,000.
Not
So
bad.
in theory, you stabilize it in a snap of a finger once the lease is signed. You can turn around and sell it and make a good chunk of change to reinvest into something else.
Wow.
So if I was investing into someone else's deal, I would look at for something like that where I could return a multiple on my money a little
Okay.
bit quicker, so I can reinvest it in opportunities that I'm personally doing.
Love it. And I will just add, so it sounds like you're a growth investor with your investment dollars today because you've got cash flow from other businesses as well, right?
Yep.
So very, very different than maybe what a new or newer passive investor might do. So really important to understand that piece as
And
well.
now
Well,
that was just me speaking selfishly,
sure,
because if
sure.
if I have a lull in my own investments or the opportunities that I'm doing, I don't like letting cash just sit there without
Yeah,
earning interest, right? Earning a
sure,
return.
sure.
So I would look to do that so then I can put it back into one of my deals that I know I'm going to hold on to for at least 10 years.
Absolutely. You trust your own work ethic and grit um, and your own management of the assets more than others. Makes perfect sense. So, well, very good. Well, this has been a lot of fun. Can you share with the audience how they could contact you if and when they would like to connect with you?
Yeah, absolutely. You can contact me through Instagram, Ben_Kall, Kall. So Ben_Kall on Instagram. Or you can check out our website, legacyinvestmentgroup.com. We keep that fairly up to date of the projects that we're currently working on, some of the deals that we're currently operating, the return profiles. And then there's also a contact page if anyone would like to set up a formal time to talk one-on-one, to do a Zoom meeting, or if you happen to be in Minnesota, feel free to look me up and I'd be happy to get coffee or a beer with you sometime.
Awesome. Well, Ben, thank you so much. This has been a really fun conversation. I love learning more about you and Legacy and all that you're doing. And I have a feeling I'll be following up with you to talk about some investments in the future as well. So thank you.
Yeah, no, absolutely. This was a lot of fun today. Thanks a lot, Randy.
Awesome. All right. And to our listeners, as always, I want to thank you again for joining us today. As always, I encourage you to continue your education journey in passive investing, but more important than that, make the decision to get off of the sidelines and place your first capital investment in this space. I'm confident that once you do, you'll be so glad that you did and wish you had started sooner. So be sure to join us again next week for another great episode. And thank you all for joining us today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.